I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. Interesting stuff happening, even though it may not seem like that to most people when it comes to the stock market.
Yeah, it seems that after about a solid week or two of gains, we're taking a little bit off the table today.
Well, it's actually this is one of the most remarkable months I've ever seen when it comes to the stock market, because we did have a big tumble in January. We have, of course, rallied and come back up, and in June we had 2 days of intense selling on huge volume on that Brexit vote, but we came back. The market made a little bit of a new high. But what's interesting is in August, the volatility in the stock market has shrunk to absolutely nothing. I use something called Bollinger Bands to measure this, and it looks at how much does the market go up or down in any given day, and those bands are very narrow. They've gotten more narrow than they've been since 1993. So you're talking 23 years just about here. That what that means is the market is not doing anything day to day this month in such a way that you got to go back 23 years to see that. So the volume's vanished, and it seems as if nothing's really happening. But a big drop in volatility like that typically serves as a prelude to a big move. And I think one question people should ask themselves is, why is this happening? And what does it mean? And I think one big news item I read this morning, which could actually prove to be the most important news item of the year when it comes to the financial markets, is that the stock buyback programs that corporations have been engaging in the past couple of years has been massive. It's been record breaking, and it's helped push the stock market up. It's happened because interest rates have been set so low. It enabled corporations to borrow money to buy their own shares, while actually the regular investor, the small investor person, has actually been taking a little bit more money out of the market than they've been putting in. Not necessarily because they're scared or bearish, but because they need the money. The economy's bad, and also people, as they get older, they need to withdraw money from the market to live, and that's what's been going on. So the market's been going up, not because of Fed manipulation, not because of some mania among people to throw money at it, but because of these stock buybacks. And the news item today is that these share buyback programs have been cut. In fact, they've been reduced to a level lower than we've seen for years, as low as they were in 2012 before the big boom and the buybacks happened. Now, no one, of course, knows the exact reason this is happening. You can't talk to corporate CEOs and get an answer like that from them. Speculation is that it's due to the fact that stock prices are so high, and the corporate masters know that fact. And also, it could be due to a fact that earnings are bad. Earnings are poised to shrink again this quarter. They've shrunk almost every single quarter for the past year. And at some point, that puts stress on companies. And a lot of these companies have been going into debt to do the buybacks, which at some point becomes unsustainable. So we may have become or be approaching a fundamental breaking point where these buybacks simply cannot continue. The problem is, without the buyback buying fueling the market and keeping it up, I think it's going to run into trouble with without that buying there, and the volatility has shrunk to nothing because there's not much trading volume going on. And that happened last August, but now it's even more extreme than that. At this point in time, without the big buybacks, I think really it's program trading that's probably dominating the market action, and program trading doesn't invest. It doesn't, it just buys something and sells it within seconds. So that's what is dominating the market now. It's a situation that will change, and there will be fireworks, but it might be a couple weeks away. It might not be till Labor Day, and people will wake up one morning and see, something's happening.
Well, I was just wondering, will we see another August 24th, a Black Friday this year?
I don't know. That's the good question, and I'm not really sure. I do think that what will happen is the market will go lower, but I'm not sure how it's going to happen. I don't know if it will be like the August 24th situation, or if instead the market just kind of falls a little slow down to, let's say, the S&P 2000 level or 2000 to 2050. That's kind of the support range. That's the low of June, and where the 150 and 200-day moving averages are. That flash crash event from last year actually happened when the market broke those 200-day moving averages, the S&P and the NASDAQ. So we're still pretty far above them. I would guess we're just going to fall slowly to that, and then maybe hold up or bounce. Then we'd have to see what's going to happen. But that's very speculation on my part. And the biggest thing, what makes me not really sure how things could unfold on the downside, is we've never seen the stock market in the situation it is right now. No one's ever seen this. What it is the volatility this low, stock prices this high at the same time. And we'll see what kind of combination that leads to. But I think what people should do is actually get a little cautious. If they have stocks they're not sure they want to own anymore, I think selling them now when the market's at a very high price is a good idea. And making sure you're diversified and not owning just S&P 500 stocks, but own some gold, maybe even bonds. Long term, I'm not really bullish on bonds. You can't get any interest on them, so it's kind of crazy to tell people to buy them, but it's a safety trade if the market does fall. In physical gold and silver are things to own. Actually, it's funny, I had someone send me an email that doesn't know anything about the financial markets, and he said his son is getting $5,000 and his mom wants a good dividend stock to buy. And I replied to it, and I said, well, Philip Morris is a big dividend stock relative to other companies. And then an hour later, I thought about it and got back to my computer, ran back to the computer. I don't want this kid buying that. I said, forget it. Just buy silver. You want to buy something that's in a new bull market. It's only, not even a year into new bull market, and you don't want to buy something like Philip Morris or most stocks until they fall. The time to buy is after people lose money and they're crying. We're not at that point yet. It's that's an exciting thing to tell people. It's not what they want to hear, but it's a weird situation right now that we're in.
Yeah, and you really don't want to be telling your kids, let's invest in cigarettes.
Yeah, no, that's true too. Yeah, that's a good point. Well, actually, what I said is just buy physical silver. If you've got $50 or $5,000, you can buy a ton of it, and it's something fun, to look at. I think that'd be a fun investment for a teenager or a kid, because there you got it in your hands, and you can feel it. It's real, instead of turning on your TV and looking at some crazy stock ticker and hoping it's going to go up after it's already gone up for 9 years or whatever it is. So there we are. But it's weird, because I'm actually getting more emails like that from people that aren't really engaged in the stock market on a daily basis, or not even listening to your show, but just random people from where I live that are like trying to just start out. And that's really weird because I don't, it's just kind of strange. I haven't noticed that kind of thing happen for a very long time. And that makes me think that, the bullishness on the media, on TV, and the fact that the market's gone up for so long, there's been so long since we've had a bear market, is making people that really don't know that much try to get into the game. And that's not really what you want to see. But anyway, at the same time, some of the smartest investors in the world, especially when you look at their track records, are hedging themselves or even betting against the stock market. In the news this week, of course, is George Soros. A lot of headlines are made because earlier this year, he bought a massive position in GLD calls. GLD is the ETF that tracks gold, and a giant position in Barrick Gold, the gold mining stock. And he did this in the first quarter. In fact, the GLD position was something like 9% of his total portfolio, and at the same time, he had a 9% about position of puts on the S&P 500. At the time, there were all these headlines saying Soros is bearish, he's betting on a market crash. When that news came out after the end of the first quarter, and I looked at the filings, that wasn't really what he was doing. What he was really doing was hedging long positions he already owned. He wasn't net short in his account. He was just obviously seemingly worried about a possibility of the market dropping, and he wanted to protect the money he had. Now with gold, obviously, he was very bullish, buying the call options, buying the Barrick position. Now, what happened this week is new filings came out which show that he took profits on his gold call position, and he's pared back the Barrick position, so it makes up about a little less than 1% of his entire net worth or his entire portfolio, and that's like a typical size position for his stocks, a little bit around 1% or 0.9% or so. So he had a big position in Barrick, and he's reduced it to a normal position. He sold his GLD, and what he's done with the GLD calls is bought more S&P 500 puts. He's doubled that position, so it makes up 17% of his entire portfolio. I mean, you're talking about tens and tens of millions of dollars. He made a couple $100 million over the course of the second quarter. So he obviously is a moneymaker, always has been. But what the thing is the people that were saying he was betting against the stock market and betting on a crash and this and that in the first quarter, they were wrong about that. He was only hedging, but now he is betting on a market drop. There's no denying that. And so is Paul Tudor Jones, who is another famous man who's got $35 billion in assets that he's playing with, and he's bought a massive put position too. It makes up a little over 20% of his stock net worth, so that's absolutely incredible. So there's two of the most famous, most successful people in the financial markets who are betting against the market. That doesn't, mean everyone out there has to bet against the market. I do think it means that it's time to look very carefully at how you're invested, and if you have positions you don't like, take money off the table or raise cash. The time to buy is on drops and downturns, in bear markets even. Now with gold, it's in a bull market. It's great. But I'm even a little cautious on telling people right now just to buy more if they already own some. I have a core position that I'm holding. I plan on holding for the next couple of years because it's very difficult to time the markets or any market perfectly every single time. So I don't want to try to do that. I want to invest in things I think are going to go up for several years. Now, if you're right, when you take an investment position in a sector, it'll go up. And say you put 10% of your money into something and it doubles, well, now you got 20% of your money in it. And with gold and mining stocks, I took core positions earlier this year, and they've gone up quite a lot. And I don't want gold or mining stocks to be 100% of my portfolio because they're just going up and up and up and up. So I have rules where I periodically rebalance my own portfolio to make sure that I'm still remaining diversified and systematically take some profits on positions that have gone up the most and try to buy other stuff that may not have gone up as much or maybe even dropped and take advantage of that. So that's kind of what I'm doing. I think it's what everyone really needs to do. I mean, if you've got the most basic investment account set up with a broker or an investment advisor in the United States, typically they'll tell you to put half your money, let's say, in the stock market, half your money in bonds. I wouldn't even do that. I would still make sure you got money in gold. But the key is you got to look and see how things are allocated now, because over time your allocations can get skewed because something will go up more than other stuff. So there's people out there that aren't paying any attention to how they're invested, and they could be 100% in the stock market or own no gold, or, you know, and be in a really tricky situation coming up here, and not really be prepared for that. And when the market's doing nothing like it is doing so far this month, it puts people to sleep. They think nothing's going on, then all of a sudden they wake up and everything is moving so crazy and they get scared. But if you prepare ahead of time and study things now, there's no reason for anyone to be scared, no matter whether the market goes up or down.
We'll have more with Mike Swanson right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Mike Swanson. Mike, some people have likened the markets today to sort of like the old duck swimming. We're on top of the water. It looks very calm and placid, and underneath its legs are just churning like crazy. Is that what's really happening? There's a lot of stuff happening behind the scenes that most people aren't aware of.
Well, what's really been happening is pretty simple. It is the stock buyback stuff that's made the market go up over the past couple of years. It's not that, really complicated. Companies are borrowing money to buy back shares. The thing is, though, that's an invisible thing. You don't see it. No one's going to call you on the phone and tell you, you own GM stock, but we just, borrowed X amount of money to buy our stock. They just do it. And it does make the market seem calmer than it is. But at the same time, what has happened is there's been a collapse of real liquidity in the market, and that's really why this month it's trading the way it is. What that means is there's fewer people doing it real buying or selling. A lot of it is now these trading robots, and what that does is it makes it so there's fewer and fewer stocks that are actually actively being traded. For example, if you take a look at the biotech sector, that sector was red hot in 2014. It's really the last pure bubble momentum sector in the stock market, but it topped out, and it's been lagging ever since. It topped out last year and performing worse in the market. But there's ETFs that track that sector that anyone can buy and trade, and big cap stocks, a couple that trade on the S&P 500. Well, what happens is, if you look at that sector, the big caps, such as Amgen, Biogen, they have a lot of trading volume. When the market rallies, they tend to go up with the market. So if the Dow's up one day, they'll be up a little bit. But then when the Dow falls, they tend to fall worse. So they're really miserable things to try to own. But what's interesting is that the stocks that aren't the big caps and the stocks that are not in the ETFs, because if you buy an ETF, the ETF also buys the stocks in it. So if there's a biotech stock not in an ETF, not on the S&P 500, it's getting no volume. And when the market goes up, it doesn't seem to go up at all. And the market falls, they just dump. There's no real trading going on in them. And that's a symptom of a disappearance of liquidity in the market. And it's a good example where you can see this. And that's a troubling sign, because I remember in March 2000, when that market topped out back then, there were all these internet stocks that were really popular to trade, but after the top, so many of these internet stocks turned into what the biotech stocks are like now. They wouldn't go up at all. No one was trading them anymore. They were illiquid, and they would just fall and fall and fall, while eBay and Amazon and Google, well, Google was later, but eBay and Amazon, they remained actively traded. They're still around today, and they didn't have that problem. So much of the stock market is becoming something like a dead money penny stock, and that's not a healthy sign for the market. If you contrast that with gold and the mining stocks, a bull market started in them in the first quarter, and there's buying across the board in junior mining stocks, in gold stocks and silver stocks that aren't in ETFs. So that's a sign of a healthy market, a start of a real bull market. And if the market was really healthy right now, on this recent rally when it made a new high, there would have been across-the-board buying in all these biotech stocks and other segments of the stock market. There would also be a new leadership sector emerging, a new sector breaking out to a new high and just going up like crazy. But none of that's happened. So I think this rally is going to turn into a nasty trap, and that's going to lead to a big drop in October. We'll probably head down to the moving averages, and we'll see what happens after that. But if this was really the start of something big, the market should be going up right now, not stalling out and doing nothing.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.